Bismillahirrahmanirrahim. Assalamu alaikum, my dear students. Now, in our last lecture, we were able to begin discussion on macroeconomics proper. We started by looking at measures of national income, and we identified the gross domestic product as one measure which was commonly used by many countries around the world, and which was also equivalent in three different ways, that is, through the expenditure approach, through the incomes approach, or the value added approach. All three approaches gave you the same measure of gross domestic product. Now, in today's lecture, we will be able to use these foundations that we have developed to kick off discussion on a model for the national economy. We'll first introduce some qualifications regarding the gross domestic product figure or measure that we have developed, and then we will be able to start discussion about how to build a model for the national economy and how to understand the ways in which equilibrium is reached in this economy, equilibrium employment and equilibrium inflation. Now, if you recall, in our last lecture, we introduced the distinction between value added and the total value of any transaction. We gave the example of the simple case where there was a firm A, which was involved in transforming raw iron into steel. Then there was firm B, which transformed steel into a body of a car. And there was firm C, which purchased the body of the car from firm B and then transformed and assembled it into the final product, that is, a car which could be then sold on the market. And we noted that the total value of transactions in that case was higher than the value added, or the sum of the value added by each of the three firms. And we noted that in that particular example, the total value added was rupees 450, which was magically equal to the final price of the good, that is the final expenditure on the final product, that was the car. And the price of that was rupees 450,000 as well. We also noted that value added was nothing but a term for the factor incomes which accrue to the household. That is, when a firm bought a good or a raw material and then added value to it, that is, incurred different types of costs. It hired labor, it hired capital, it was using some land, it also wanted to generate economic profits for itself. So when you combined all of these together, this value added was nothing but incomes that were distributed to households in return for the factors or the services that they had provided. So incomes were distributed in the form of wages, in the form of the cost of capital, in the form of rent for land, and in the form of profits. And these were simply the costs that were incurred in making that raw material or transforming that raw material into something that could then be sold on to another firm or the final consumer. So that is basically where we left the discussion yesterday. We were at a particular example, a more complex example, in which we had four producers. We had a steel producer, we had a machine producer, we had a car producer, and a tire producer. And we were looking at how the three approaches, the total product or value added approach, the expenditures approach, and the factor incomes approach would give you the identical answer, in this case, of the gross domestic product. Let's return to this example of ours that we were discussing, and once we've done that, we will come back to discuss some qualifications about the figure, the measure of GDP that we are using. Let's go first to our example. Now, if you recall, we set up this table or introduced this table in the previous lecture, where we had four columns. In the first column, we had the good that was being sold or bought. In the second column, we had the seller, the firm, or the consumer, or whatever, the person who was selling the product. So the consumer could not be there. He would be in the buyer's column. So in the buyer's column, you could have all the firms which could be interested in buying the products that the sellers are selling. And then finally, in the fourth column, we had the transaction value of each of these transactions. Now we can add a fifth column immediately, which could be relating to value added. Now if you note, for the first transaction in which the steel producer sells steel worth rupees 100,000 to the machine producer, obviously the machine producer needs steel as an input into the production of machines. Most machines use steel as a raw material in producing the machine. Thus in this case, the total value added by the steel producer would be 100,000. That is, the steel producer took raw iron, then added 100,000 worth of value to that raw iron, converted it into steel, and then sold it to the machine producer. The value added would simply be 100,000. Now in the second row, we have the steel producer selling steel to the car producer. Note here that the car producer would also need steel, as it would need to set up the body of the car. And therefore, the value added in this case would be the entire 300,000, which is the transaction value. That is, the steel producer sells steel worth 300,000 to the car producer, but the entire value of the transaction, 300,000, is value added because the steel producer started from raw iron, in which case the value of which we assume to be 0. The third row sets out an interesting example, in that here it is the machine producer which is selling the machine to the car producer. The car producer might need some machines which are used in the production of cars. So the car producer would need the machines to use in the production of cars for perhaps a long period of time. So the car producer in a way is the final purchaser of the machine. Now note that the machine producer bought the steel from the steel producer for rupees 100,000, and now it is selling the machine to the car producer for 200,000. Now it bought steel at 100,000 and sold it to the car producer for 200,000. That is, in producing the machine or manufacturing the machine, the producer added value of 100,000, and this is what is shown in the fifth column. Then we have the tire producer, and we simply assume that the tire producer produces tires, sells them to the car producer for 50,000. That's the value added in that case. And finally, you have the car producer selling the car to consumers. Now you have to focus here on lines 2 and line 4. You need to ignore line 3 here, because the machine was purchased by the car producer as a final product. The car producer will be using the machine forever. The only two things that the car producer bought and added value to were the steel that he bought from the steel producer for rupees 300,000 and the tires that he bought from the tire producer for rupees 50,000. So the total cost of these two inputs was 350,000. Then the car producer added value to these two things, that is the steel that it bought and the tires that it bought, added value to these two, and then took the value to 500,000. So the value added would simply be 500,000 minus 350,000, which in this case is shown as 150,000. Now look at column 6, which is the column for expenditure on final goods. Now note that there are only two entries here. The first entry corresponds to row 3, where the machine producer sells 200,000 worth of machines to the car producer. Now the car producer pays 200,000, and although the car producer is not a consumer, but in this case, because the car producer will retain the machine forever for future use, therefore it's kind of a final consumer in this case. And therefore, this 200,000 is recorded in column 6 for row 3. Finally, if you look at row 5, the answer is simple. You have the consumer spending rupees 500,000 on a final product, that is the car, and that is obviously shown there as well. Then you look at column 7. Column 7 simply has all the entries corresponding to the rows in column 5. So you have 100,000 factor earnings corresponding to the value added of 100,000 in row 1, and similarly 300,000, 100,000, 50,000, 150,000. And this is consistent with the argument that I gave earlier. That is, whenever a firm adds value, it incurs costs in adding that value, and those costs are simply wages, the return on capital, rent, profits, and those are simply the earnings that are distributed to the owners of the factors, that are the households in this case. So the column 7 entries and the column 5 entries are definitionally equivalent. Now, surprise, surprise, if you total the entries in columns 5, 6, and 7, in all of those cases, you will get a total of 700,000. And this is the miracle of national income accounting and the three measures, that whether you use the value-added approach, the expenditures and final goods approach, the factor earnings approach, if you've got the concepts right, then you should get the same answer for GDP in all of those cases. Note that the answer that you get for GDP, that is 700,000, is much lower than the total transaction value obtained in column 4, which is 1,150,000. And the difference simply relates to the double counting that column 4 does. That is, it not only adds up all the value added, but it sometimes double counts that value added when it assumes that the starting value for all of these transactions was 0. That is, it assumes that the value added for the first transaction was 100,000 minus 0, for the second one is 300,000 minus 0, for the third one is 200,000 minus 0, whereas actually the value added, the right value added computations are shown in column 5. Now we've developed a basic understanding of how the gross domestic product calculation can be done for a simple economy. And the principle is exactly the same no matter how complex this economy gets. The principle is basically that you add up all the value added, and then that should be equal to the total incomes or the total expenditure on final goods. Once we've developed this basic understanding, we are now in a position to discuss some qualifications, some related concepts to GDP, which are important if we are to understand what the GDP represents and what it misses out. Let's now turn to these qualifications, beginning with two measures of GDP, that is GDP at factor cost and GDP at market prices. Now, when you say GDP at factor cost, you're basically referring to the price at which a firm sells its final output to consumers. That is the total costs incurred by the firm in producing a good. So if you go back to our earlier example of firms A, B, and C, where the firm C sold the car for rupees 450,000, that rupees 450,000, the price at which the firm was willing to sell the car to the final consumer, would be the GDP at factor cost. However, sometimes the government imposes indirect taxes. Sales taxes are an example of indirect taxes. Indirect taxes are those taxes which are imposed on consumption. They are not imposed on income. There's a slight difference there. Indirect taxes are paid by the consumer when he buys a particular product, whereas income taxes are taxes that the consumer pays or the taxpayer pays as a percentage of the total net income that he earns. Now, if you have a case in which indirect taxes are being charged by the government, then the price at which the producer will be willing to sell his product and the price that the consumer will have to pay will be different. So in the example that I just quoted, if the price of the car was 450,000 and the government imposed a 10% indirect tax or a sales tax on the purchase of the car, then the consumer would have had to pay a price of rupees 495. That is 450 plus rupees 45, which is 10% of rupees 450. So the GDP at market prices, that is the price that the final consumer would have to pay, would simply be the GDP at factor cost plus the indirect tax. If you turn the equation around, then GDP at factor cost is equal to GDP at market prices minus indirect taxes. And that is what is shown in the plasma slide. Now let's go to a second qualification regarding GDP. And that qualification relates to the distinction between gross versus net national or domestic product. We're still talking about domestic product because national versus domestic is another debate. Now, when you have gross domestic product, you do not factor in for the depreciation of the capital stock or the natural resources in your economy. You're basically taking all the product that you have produced and you're not taking account of the loss in value of the machinery or the capital stock in producing that output. Now, this can be a pretty important distinction. In reality, when you use any machine or any capital equipment to produce a car or some product, then that machine also loses value in the process. And that loss in value, if you remember, was denoted by depreciation. That there is depreciation in the value of the capital equipment. And depreciation is an economic cost. And therefore it needs to be shown in our figures. It needs to be subtracted from the gross domestic product or the gross domestic income measure that we come up with in order to get a net income or a net national, net domestic product measure. Now, depreciation in terms of capital stock or depreciation of capital stock is relatively easy to understand in that when the capital stock depreciates by, let's say, 10%, you simply deduct that 10% in depreciation, that 10% of the total value of the machine, and you deduct it from the gross domestic product. Once you deduct it, you get the net domestic product. But when you have depreciation of natural resources, that is, let's say, the forests in your country or rivers or the water resources in your country or oil resources, and if you use those resources up, then not only will the depreciation that is happening be a permanent depreciation, that is, will be a permanent loss in the value of the resources or the inputs that you are using for production, but this will also jeopardize your future chances of production, the ability of the economy to produce in the future. So if suddenly you start producing more and more furniture in the economy by cutting down all the woods in your country, then you will be left with much less wood for future production of furniture. So your permanent capacity to produce is damaged. So this is a slight distinction between depreciation in capital, which can be replenished by reinvesting in capital. But if you lose your natural resources like oil or forests or water, there is often no way of replenishing those natural resources. So note the relationship, my friends, between gross domestic product and net domestic product. That is, net domestic product is simply equal to GDP minus depreciation. Oh, I'm sorry, that NNP should actually be NDP, net domestic product. That middle N here actually refers to national, which shouldn't be here, but that is mainly because I might have been thinking ahead, because our next slide is about gross national product. So the N does come here. Now, what's this concept that we are talking about? Gross national product is simply equal to gross domestic product plus net factor incomes from abroad. Now, what does this mean? Gross domestic product simply refers to the total quantity of goods and services produced in the economy, that is, within the boundaries of the economy. So it will be the total value of goods and services produced by all the residents of the country. So note the difference between resident and citizen. A citizen of a country is somebody who holds the passport for that country, that is, who is a national of that country. Now, whether that national is residing in his country of nationality or not is another matter. It is not necessary for me to be a Pakistani national and also to be residing in Pakistan. I could be living somewhere else. I could be living in Nicaragua, in Tanzania, in Australia. So it's not necessary for nationals or citizens of a country to be also living in that country or to be resident of that country. Similarly, it is very possible for citizens of other countries to be living in this country. That is, it is possible for American nationals or UK nationals or European nationals to be living in Pakistan, that is, residing in Pakistan. Now, the contribution that they make to the total product, to the total output, will be included in gross domestic product. But when you talk about gross national product, you're only interested in the income or the product or the services which are produced by the nationals of the economy. That is, the incomes, the total income accruing to Pakistanis alone. Now, what are net factor incomes from abroad? Net factor incomes from abroad simply is the difference between incomes that are sent back, that are remitted by Pakistani nationals working abroad. So when they send their money, the income that they earn abroad, send it back to Pakistan, that is an inflow to the gross national product. That is an inflow for the total income earned by the nationals of the country. Similarly, foreign firms or foreign individuals working or residing in Pakistan, when they send their salaries or the profits that they earn back to their home countries, that is an outflow, right? That repatriation of profits or incomes outside of Pakistan is an outflow from the point of view of GNP. So once that difference is established, which could be positive or negative, that is, net factor incomes from abroad could be positive or negative. They would be positive if the money coming in from Pakistanis working abroad is greater than the money sent out by foreigners working in Pakistan. So that, when adjusted with the gross domestic product figure, gives you the gross national product figure. Our next qualification or concept that we need to understand is that of national income. Now, we've been talking about national income again and again, and as if it meant the same thing as gross domestic product. There is a slight difference. When we talk about these things in theory, there's not much of a difference, but from an accounting point of view, these distinctions are important. So the national income is simply the net national product. And you know how you get from gross to net. We got from gross domestic product to net domestic product by subtracting depreciation from gross domestic product. Similarly, net national product can be obtained by subtracting depreciation from gross national product. And this is exactly how we do it here. So national income is equal to net national product. Now, all these different accounting concepts for something which essentially is the same at a theoretical level, that is, these net national product and net domestic product and gross national product and net national product, net domestic product, these concepts can become quite confusing. So it is useful to summarize these concepts in terms of either a graph or a figure or some illustration. And this is done very nicely in one of your textbooks. So let's refer to how one can summarize these different accounting concepts and put them all together in one picture. It will be very useful for you to memorize and clarify your understanding of these concepts. Let's look at that figure. Now you start with the first block in this figure, which stands for GNP at market prices. Now, if you subtract the net factor income from abroad from this GNP market prices, you get GDP market prices. And this indeed is the definition of GDP. GDP is simply GNP minus net factor incomes from abroad. Now, in the third block, if you subtract depreciation from GNP market prices, you will get net national product at market prices. That is NNP at market prices. And that also follows from the definition that we introduced earlier. That is NNP or NDP is equal to GNP or GDP minus depreciation. Now in the fourth block, we simply deduct indirect taxes from net national product at market prices. And note how the subscript MP now changes to FC in the fourth block. So from net national product, you go to net national product, but now the subscript is FC, whereas earlier it was MP. The fourth block is obviously the definition of national income as we know it. In the final block, we simply have a summation of all the factor earnings or the factor costs or the value added by firms in producing the goods and services that we are talking about or valuing. And note that this is basically a summation of rental income, profits, income from self-employment, and wages and salary. These are the incomes that household get and which they then spend on the net national product at factor cost. Note that the total factor incomes is equal to the total factor cost or the cost of adding value to inputs or the raw materials that firms get. Now keep that summary blocks in mind. Keep that summarization of those 4 or 5 different accounting concepts clearly in your mind, because they will help you not only in understanding these concepts better, but also in the exams. Now, one final important distinction that you need to make when you are talking about GDP or GNP is the distinction between real versus nominal figures. Now, nominal GDP would simply be the total quantity of goods and services produced in the economy multiplied by the prevailing price level, that is prevailing prices. So if 100 cars are produced and the price of cars is 100, then the total GDP in respect of cars will be 10,000 rupees. Similarly, if 5 apples are produced and the price of each apple is 40, then the total GDP in respect of apples will be 200. However, note that the prices of cars and apples changes over time. So if you compare the total GDP today, which is valued at today's prices, with the total GDP or nominal GDP of an earlier year, then you would be comparing a product of the quantity and prices with the product of the quantity and prices. So if you want to get a true measure of the level of economic activity, you would like to compare only the quantity part of those two figures. You would like to control for the price part of the two figures. So you need to find a way in which to control the price variation that is embedded in the nominal GDP and obtain some kind of a real measure which you can then not only compare with GDP or the real GDP in other years, but also compare with other countries. So let's see how this can be done through some examples and also through some formulae. Let's go to our slides. Now the key formula to note here is shown in this equation. That is the real GDP in year A, or which it could be any year, is equal to the nominal GDP in year A multiplied by the price index in the base year divided by the price index in year A. Now the price index of the base year is simply the year with which you want to compare the real GDP. So if the base year is year B, then the numerator in this case would be the price index of year B. Let's look at an example. Assume that the country shown here has a nominal GDP of $150 billion in 1985 and of $300 billion in 1994. Let us also assume that prices have risen by 50% over that period. Thus, if the price index was 100 in 1985, it would be 150 in 1994. Now, what is real GDP in 1994 measured in 1985 prices? That is controlled for the change in prices that has happened from 1985 to 1994. Applying the formula, we get real 1994 GDP is equal to $300 billion multiplied by 100 over 150, where 100 is the price level prevailing in the base year and 150 is the price level prevailing in the year of interest. And therefore we get a real 1994 GDP of $200 billion. Now, the process through which the nominal GDP was converted into real GDP is called deflation. And the ratio of the base year price by the year of interest price is called GDP deflator. That is, when you multiply the nominal GDP by the GDP deflator, you get the real GDP. Let's now illustrate through the use of a simple example of an economy which just produces two goods, apples and chicken. And let's see how we can actually construct the GDP deflator in this case by constructing the two price levels. Because I'm sure some of you have already started thinking as to how is the price level constructed. That is, you can understand how individual prices of goods could be different and how they could be aggregated, but you possibly can't understand how they could be aggregated and weighted together to form a price index, which can then vary from 100 to 120 and 130. Let's use this example of apples and chickens to illustrate how price indices can be formed and then could be used to deflate nominal GDP to real GDP. Let's go to our example. Now, as you can see in this table, we have two products, apples and chickens. We have 2 years, year 1 and year 2, and we have the output and price information for both these years for both the products. So in year 1, we have the information that 100 apples and 100 chickens were produced. Apples, or each apple cost rupees 2, whereas each chicken cost rupees 4. This must be way back in the 1960s or 70s, because certainly today apples don't cost rupees 2 and chickens don't cost rupees 4. Anyway, now in year 2, we have apples that are produced in a quantity of 150 and chicken which are produced in a quantity of 140. And now apple prices have risen to rupees 4 per apple and chicken prices have risen to rupees 6. Now, if you were to calculate the nominal GDP in both of these years for this economy, now this is the whole of the economy that we have, then you would get 100 multiplied by 2 plus 100 multiplied by 4 is equal to 600 as the nominal GDP for year 1, and 150 multiplied by 4 plus 140 multiplied by 6 is equal to 1440 as the nominal GDP for year 2. Now, the growth rate in the nominal GDP from year 2 to year 1 would simply be 1440 minus 600 over 600, and this gives a growth rate of 140%, which is a very high growth rate. Now, let's try to deflate the nominal GDP in year 2 to reflect the quantity change or the change in the level of activity in the economy and control for the change in the price of apples and chicken. Now, the key thing to do here is that we construct first the index for the base year, the price index for the base year. So you use the quantities of output in the year 2 and use the prices of year 1. So the price index can be calculated by multiplying 150, that is the number of apples produced in year 2, multiplied by the price of apples in year 1. So it's 150 times 2 plus 140 times 4, and then you divide it by the total quantity of apples and chickens produced in year 2 to get a weighted average price level, and that you get as 2.966. Similarly, you can get the current year or year 2 price index by multiplying 150 by 4 plus 140 by 6 and then dividing the whole by 290. And this will give you the per unit price level prevailing in the year 2. That is the current year price index. And this comes out to 4.966. Now it is very simple to construct the GDP deflator from this information. All you need to do is to set up this simple cross multiplication problem. That is 2.966 corresponds to 100, then what would 4.966 correspond to? And if you do this cross multiplication, that is x times 2.966 equals 100 times 4.966, you will get x as 167.4% or 167.4. And this 167.4 is then the price level prevailing in the current year, that is year 2. So you have the base year price level as 100 and the current year price level as 167.4. Now we can simply use the formula that we earlier developed for real GDP by multiplying the nominal GDP of 1440 by 100 and then dividing it by 167.4. 100, which appears on top, is the price level prevailing in the base year, that is year 1, and 167.4 is the price level in year 2, and this will give us an answer of 860. So the real GDP in year 2 is 860. We can now compare this real GDP with the real GDP in year 1. Note that in year 1 the real GDP would be equal to the nominal GDP because the year 1 price level is also taken as the base year price level. So if you multiply the nominal GDP of 600 by 100 and you divide it by 100, you still get 600. So the real GDP in year 2 can now be compared with the real GDP in year 1 to get a measure of the economic activity change that has happened. And if you do that, you get a growth rate of 860 minus 600 divided by 600, which is equal to 43%. So that was a brief discussion of nominal versus real GDP and how it can make a real difference as to whether you're comparing nominal figures and real figures in order to get an idea of the change in the level of activity of the economy. And in this particular case, we saw that if you used nominal figures, then you got growth rates of 140%, whereas if you used real figures, then you got growth rates of 43%. So a big difference. Now, with that, we can now turn to a new question in terms of what we've discussed about GDP and the qualifications and the different definitions that we've talked about. We can now address the question as to do national income accounts or national income accounting concepts give an idea about the underlying living standards of the individuals living in a country or in an economy. So does GDP tell us anything about the living standards in that country also? This is the question that we now can ask or should ask. Now the first point that you need to make in this is the same point that we introduced earlier, that in order to get a measure of the living standards in the economy, you need to get a per capita GDP measure. So you need to develop some kind of a per capita income measure in order to see if the per individual income has increased or decreased or fallen, etc., etc. Note that we are not talking about income distribution here, but that is an equally important question. It is possible for the total income to have risen, but the income distribution to have worsened. That is, the rich might have become richer and the poor might have become poorer, but the rich might have become so rich that they take the average income of the population up with them. But this says nothing about how badly the poor are doing. Now, in order to deal with this question of per capita income and total income, we recall our earlier example of China versus Switzerland. We saw that China back in 1992 had a per capita income of $470, whereas Switzerland, which was a much smaller country, although having a lower aggregate GDP, had a per capita income or per capita GDP of about $36,000, which was very, very high. Now, this tells us something about living standards, that an average individual or the mean individual in Switzerland is earning much higher incomes than the average individual in China. But the one point that it does not capture is that it does not capture the purchasing power of the $470 that an average Chinese person is earning. For this, we need to reintroduce the concept of prices. Are the prices prevailing in Switzerland the same as they are prevailing in China? So can the $36,000 in Switzerland, can they be seen as a multiple of $470, that is 160 times? Can $36,000 buy 160 times the goods that $470 can buy in China? Let me put it differently. Can rupees 100 that you have in Pakistan earn the same number of goods and services that the equivalent amount in, let's say, UK sterling or Great Britain pounds? That would be £1 and some pennies. Could that earn the same amount of goods in UK that rupees 100 would earn in Pakistan? Very unlikely. Things are extremely expensive in the UK. You might even not get peanuts, whereas here 4 or 5 people can eat a full dinner inside rupees 100. So it depends very much on the purchasing power of the income that individuals have. It is possible for individuals to have a low level of income but still have high purchasing power. This is why in human development reports, it is the purchasing power parity measures which are compared and not the simple per capita income measures which are compared in order to get an idea of how well individuals in different countries are doing. Another distinction that needs to be made when you're discussing whether GDP gives us a good idea about living standards is to notice that GDP only refers to activities which are marketed. However, there are non-marketed activities that take place in the economy as well. When I say marketed activities, those are activities which earn a price in the market. That is, when you work in an office or when you work in a factory or in a bank, you are paid for that, right? When land is offered for rent, then that rent is the price of the land that you get. So all the activities which earn something in the market, which are offered on the market, and the market puts a price on those activities, only those activities show up in the gross domestic product figure. But think about activities such as these. If you were an extremely good person and one day you decided to paint the wall in your house all by yourself, right? So you came home with a bowl of paint and you started painting your wall. And by the end of the day you were done and your wall was looking very nice, and everybody in your house was very happy with you. Now this is a concrete activity that has been undertaken in the house and in the economy as a whole. But will it show up in the gross domestic product figure? No, because it was never marketed. You decided to paint the house yourself, and there was no remuneration or explicit remuneration that you got for it. Therefore, this kind of activity will not show up in the gross domestic product figure. This becomes a serious problem in countries where a large segment of the population is offering services which are not marketed, especially developing countries where women often stay at home and do household chores or maintain the house. Now that is a real activity that they undertake. But because this activity is not marketed, the market does not put an explicit value on these activities, this activity does not show up in the gross domestic product figures. Therefore, the GDP in a way is understated or understates the true level of activity in the economy. When a lot of the activities are happening in this way, that is, people are undertaking these activities at home by themselves without offering or valuing or putting a market value on these activities, then the difference between the recorded GDP and the actual level of activity will be large. In developed countries, often household chores, sometimes they are performed by members of the household, but sometimes they are contracted out in a way that people come in, they set up the house in in hotels. Now, all those activities where people are explicitly paid for maintaining houses, for maintaining offices, etc., would show up in GDP, and therefore the difference between actual GDP and the recorded GDP would not be so great. In a similar vein, we need to understand that it's only the legal economy, the activities in the legal economy or the white economy which show up in GDP or national income accounting data. So, for example, if a good is smuggled into the country and then consumed by people, that transaction does not get recorded in the GDP figure. So, if the level of smuggling or the size of the black economy in any country is very large, then there might be a large discrepancy between the recorded GDP and the actual level of activity in the economy. I'll give you a small example. It does not always have to be something as bad as smuggling or as explicit as smuggling in order to be categorized or made a part of the black economy. Think of this example. A firm hires an electrician to set up the electricity wiring in the firm. Now, in the evenings, the electrician goes around the neighborhood and fixes the wiring problems of the households there. Now, the income that that electrician gets from the firm is recorded by the firm and is sent in its annual accounts, and that shows up as part of the gross domestic product. However, the work that the electrician does for the households in the evening is part of the unrecorded activities. The person goes to these houses, he sets their wiring up, the people pay that electrician in return. They pay him on an hourly basis or whatever. But that person, if he does not declare that income and the households don't declare that expenditure, then that activity will not form part of the GDP. Now, in some countries, the difference between the black market adjusted GDP and the actual GDP can be huge. In some countries, the size of the black economy can be as big as 3 times the size of the actual or recorded economy. So this is a major factor to note when we talk about GDP and whether it measures the true level of activity or welfare in a particular country. Now, 2 final points to note about whether the GDP is a good measure of the welfare or living standards prevailing in a country. The first point to note is about externalities. Remember that we introduced externalities towards the end of our microeconomics module, and we noted that externalities could be negative or positive. Now, in the specific context of negative externalities, particularly things like environmental pollution, noise pollution, waste that is produced when firms produce chemicals or things like that, then all these activities or all these things should be subtracted from the gross domestic product in order to get a better measure of total welfare in the economy, right? So you need to adjust the gross domestic product figure downwards for things like environmental pollution, noise pollution, because all these externalities reduce the welfare or the standard of living of people. It's a nuisance sometimes when these large buses go around with these big horns. It disrupts your comfort level. So this is something that we could adjust for. Another thing that we could adjust for is the importance that people or different societies assign to leisure. For example, when we talk about GDP, we are only talking about the total consumption in the economy. However, it is entirely possible for 2 countries or citizens in 2 countries to view consumption differently. Some people might attach more value to consumption. Other people might attach more value to leisure. So it is possible that one country has a per capita income of $300, another country has a per capita income of $250, but the people in the $250 economy are more happy have higher welfare because they attach more importance to leisure, that is relaxing. So they don't have as much money as the other economy to spend on goods and services, but they have more time to relax. So this is a second qualification that one could make when arguing as to whether the GDP is a good measure of welfare. Note that things like externalities, things like non-marketed activities, and this distinction between how much weight people assign to leisure or how much they value consumption relative to leisure are difficult to put a price on. It's difficult to value these things, and therefore often these are or cannot be included in any overall aggregate measure of national income. Now, with that fairly comprehensive understanding of the gross domestic product or gross national product measure of total income or total activity in any economy, we are now in a position to talk about the overall model for any economy, for a national economy. We can talk about the determination of equilibrium output and inflation in an economy. We will refer to, in this case, the circular flow of income. We will do this in our next lecture. We'll talk about withdrawals and injections, and we'll see how the circular flow of income can help us develop this model for the economy. Then we will also use the circular flow of income to highlight the distinction between classical economists and Keynes and how they viewed the individual injections and withdrawals, whether they thought that the individual injections and withdrawals had to be equal or whether these injections and withdrawals had to be equal in aggregate. So we look at some of these debates. Don't get bogged down by the terms that I'm using. We will clearly explain all of these terms. So be patient and look forward to the next lecture. So my friends, with that, we come to the end of today's lecture. Now, some of you might be wondering that the way we've been discussing macroeconomics, we tried to answer one simple question as to how we could measure the total level of activity in the economy. But once we answered that question, we opened a Pandora's box. We opened a number of other questions about net domestic product and gross national product and net income, net national income. Then we talked about real versus nominal income. We talked about marketed versus non-marketed activities, externalities. So a whole range of issues were opened up just because we were able to answer one question. This is the beauty of macroeconomics. Get used to it, and the more you get used to it, the fact that when you answer one particular question, 10 more questions open up. The more you get used to it, the more you will enjoy macroeconomics. So keeping that thing in mind, it's Khuda Hafiz and Assalamu Alaikum.